We're seeing a massive divergence in the market as stocks hit new highs while Bitcoin struggles below key resistance. Insiders are pointing to institutional gains, with big players selling on public markets while buying huge amounts privately. At the same time, a historic altcoin season could be just around the corner, with Bitcoin's dominance dropping to levels that previously kicked off massive runs. But you need to be careful. Sophisticated scams involving wallet drainers and supply chain attacks are getting worse, with one whale losing a shocking $32 million. With the Fed expected to cut rates and analysts predicting Bitcoin could hit $200,000 within a year, the next few weeks could define the rest of this bull run. Are you prepared for the volatility ahead? In the latest video from Altcoin Daily, host Aaron Arnold speaks with Howard Wu, the founder of Alio. Howard explains that Alio is a Layer 1 blockchain built to support private smart contracts using zero-knowledge proofs. He describes it as what you'd get if Ethereum and Zcash had a baby. The main issue Alio addresses is that most blockchains, like Ethereum and Solana, are public by default, exposing all user transaction data. This creates problems for both individuals and businesses, as their entire financial history can be tracked. Alio is designed to be private by default, allowing developers and users to choose what information becomes public. A key application mentioned is S-Pass, a system for verifiable credentials that can handle KYC requirements without forcing users to hand over sensitive personal data. Howard predicts that Alio will capture a vast majority of the stablecoin market within 5 years and believes that by 2030, 99% of all stablecoin payments will be end-to-end encrypted, similar to how the internet shifted from HTTP to HTTPS to enable e-commerce. He also notes that Alio has a hybrid consensus model, starting with a proof-of-work element for token distribution that will phase out over 10 years, leaving a pure proof-of-stake system for long-term efficiency. Alio is positioning itself in a fascinating and potentially lucrative niche within the crypto market. The conversation around digital privacy is becoming more urgent, especially with governments exploring CBDCs. Alio's approach of offering programmable privacy is smart because it isn't just about hiding transactions. It's about giving developers and institutions the tools to be compliant in various jurisdictions. This focus on being a U.S.-registered entity that works with regulators could be a significant advantage, helping it avoid the issues that plague projects like Tornado Cash. In the latest video from Crypto Rover, the focus is on Bitcoin's persistent attempts to break a significant resistance level. The more times Bitcoin tests this level, the more likely it is to break through. A confirmed break could validate two bullish patterns, an inverse head and shoulders, and a falling wedge, the latter of which suggests a potential price target of $124,000. The recent small correction in price was attributed to a surprisingly negative payroll revision and geopolitical issues. All eyes are now on the upcoming core inflation data, which will heavily influence the market's next move. If the numbers come in lower than forecasted, a big pump is expected. If higher, another correction is likely. Historically, the last 4 inflation data releases have led to a dip. Despite the short-term uncertainty, the broader outlook remains positive, supported by a CME gap above the current price, an expanding M2 money supply, and a hidden bullish divergence on higher time frames, indicating that weakness is leaving the market. The speaker maintains his $20 million long position on Bitcoin and Ethereum, also noting that Ethereum's funding rates are cool, suggesting the top is not yet in. He's targeting a price of $6,000. The analysis presented in the video hinges on Bitcoin breaking a key resistance level, a scenario many traders are watching closely. Currently, Bitcoin is trading around $114,050, showing some upward momentum after a period of consolidation. The market sentiment is a mixed bag. While there's underlying optimism fueled by institutional interest, such as BlackRock's recent significant purchases of Bitcoin and ETH, there's also caution ahead of key economic data. In the latest video from the Crypto Tips channel, the host discusses a couple of significant topics in the crypto world. First, there's a warning about a large-scale supply chain attack that could affect crypto users, even those with hardware wallets. The CTO of Ledger, Charles Guillemet, explained that a compromised developer's NPM account has led to malicious code being downloaded over 1 billion times. This code can swap crypto addresses during transactions to steal funds. For hardware wallet users, the advice is to pay close attention to every transaction detail before signing. The video's points about the NPM supply chain attack and whale activity are timely and reflect current events. The attack, which involved popular JavaScript packages, was a significant concern for the crypto community, but fortunately, it was largely unsuccessful, with minimal funds stolen. Ledger's CTO, Charles Guillemet, did indeed issue warnings, emphasizing the security advantages of hardware wallets with clear signing features. In the latest video from Lark Davis, he gives a straightforward look at Cardano's current standing and its potential price movements. He points out a major gap between Cardano's hefty $30 billion market cap, which places it in the top 10, and its actual usage numbers. The on-chain activity tells a different story, with a total value locked TVL of only $383 million, ranking it 19th. The situation looks even bleaker when you check the stablecoin market cap, where Cardano sits in 41st place with just $38 million. Furthermore, its 24-hour DEX volume is a mere $2.9 million. Davis questions why a blockchain that's been around for 8 years shows such low user engagement while newer chains have zoomed past it in terms of adoption and activity. He suggests that the high valuation is mostly propped up by a loyal community of long-term holders rather than solid fundamentals. Based on his analysis, he offers a few price predictions for this cycle. A bearish outcome would be a peak of $1.70, which would be a lower high than the last cycle. A more moderate, diminishing return scenario puts the price at around $5. In a highly optimistic, irrational market, he mentions a potential peak of $11. He wraps up by stating that, from his perspective, investing in Cardano at its current valuation doesn't make sense when compared to other available options with stronger metrics. Lark's critical take on Cardano's metrics from the video still resonates with the current market situation, even if some on-chain data points have shifted. As of today, ADA is trading around 88 cents to 89 cents, with a market cap of approximately $31 to $32 billion, keeping it firmly in the top 10 cryptocurrencies. However, the core issue of a disconnect between valuation and usage persists, especially when compared to rivals like Solana. Solana consistently shows significantly higher daily transaction counts and a more vibrant DeFi and NFT ecosystem. In the latest video from the Ben Cowan channel, the discussion centers on gold's strong performance, having recently surpassed the $3,600 mark in September 2025. This continues a trend seen over the past year, with the price steadily climbing from $2,600 11 months ago to its current level. Cowan reaffirms his bullish stance, which he's held since 2019 when gold was around $1,200 to $1,300. He anticipates this upward trend will continue through the end of 2025. However, he foresees a mild correction of about 10 to 20% in 2026, similar to the drop seen in 2022. A key signal for this potential pullback, according to Cowan, is when silver reaches a new all-time high, which would mean breaking the $50 level. He draws a parallel to the crypto market, where Ethereum making a new all-time high often signals a temporary peak for Bitcoin. He believes the long-term bull market for gold will persist, with a likely consolidation in 2026 followed by another rally into the later part of the decade. Ben Cowan's analysis of gold's trajectory seems well aligned with current market dynamics. As of today, gold is trading around $3,654 per ounce, confirming the video's premise. The bullish sentiment is heavily supported by ongoing geopolitical tensions in Eastern Europe and the Middle East, which consistently drive investors towards safe haven assets. Furthermore, a significant trend is the aggressive purchasing of gold by central banks worldwide, aiming to diversify reserves away from the US dollar, a move that adds a strong layer of structural demand. While some reports indicate a recent slowdown in the pace of central bank buying due to high prices, the overall trend of de-dollarization remains intact. In the latest video from the Coin Bureau channel, Guy explains 5 common crypto scams that are becoming more frequent. The first is copycat tokens, where scammers create coins with similar names to legitimate projects to trick investors. These can be honeypots you can't sell or have 100% sell fees. Scammers also use these for address poisoning, sending a tiny amount from a similar-looking address, hoping you'll mistakenly send funds to it later. The second scam is wallet drainers, malicious code that empties your wallet after you sign a transaction, often disguised as a normal decentralized app connection. These are now sold as a service, and even major crypto news sites have been compromised to spread them. A whale recently lost around $32 million to one of these. The third issue is the classic shill and rug, where influencers or paid articles create hype for a token just so insiders can sell off their holdings. This can be a hard rug where liquidity is pulled instantly, or a slow rug where the team gradually sells off tokens and abandons the project. The fourth scam involves interacting with unknown tokens that mysteriously appear in your wallet. These are designed to bait you into visiting a malicious website or approving a transaction that will drain your funds. Finally, the video covers social engineering, where scammers use direct interaction, like fake support messages or deep fake live streams of personalities like Elon Musk, to convince you to send them your crypto. The video does a solid job of outlining prevalent scams, and the threat is arguably more significant now than ever. With Bitcoin currently trading around $112,092.16 and Ethereum at about $4,291.16, the high values make the space a very attractive target for criminals. The rise of Drainer as a service kits means more low-skill scammers can deploy sophisticated attacks. We're also seeing a clear trend of institutional adoption, with a 2025 survey showing 59% of institutional investors planning to allocate over 5% of their assets to crypto. This influx of new and potentially less crypto-native capital creates a larger pool of potential victims. Regulatory bodies are playing catch-up. The FBI reported a 53% increase in losses from crypto investment fraud in 2023, reaching $3.96 billion. While the industry awaits clearer regulations, which 76% of firms believe will be a catalyst for growth, the responsibility for security largely remains with the individual. The scams mentioned in the video are evolving with technology, incorporating AI for more convincing deepfakes and social engineering schemes. The current market shows strong institutional interest, with significant inflows into spot ETH ETFs, yet there's also a sense of caution as the market consolidates after recent highs. This environment of high stakes and evolving threats means that the advice to use burner wallets, verify contract addresses, and be wary of unsolicited offers is more critical than ever. In the latest video from Crypto's Russ, the host discusses a strange day in the markets where stocks reached new highs, but Bitcoin saw a decline. A major topic was the significant revision of the U.S. jobs report, which showed that 911,000 fewer jobs were added over the last year than previously stated. This revision suggests the economy is weaker than it appeared, which would typically increase the chances of a Fed interest rate cut. However, the probability of a 50 basis point cut remains low at around 7%. Big financial players like Standard Chartered and BlackRock have voiced opinions that a significant rate cut should be coming. The speaker finds it odd that Bitcoin sold off, dropping from around $113,000 to $111,000, while stocks rallied. He suggests that Wall Street might be treating Bitcoin like a commodity, selling it to raise cash for stock purchases. The video also touches on Ethereum's performance, noting it's hovering around $4,300 and appears weaker than Bitcoin, partly due to recent outflows from ETFs like BlackRock's. In contrast, Solana is showing strength, climbing back toward $220. Looking ahead, the host points to the upcoming PPI and CPI inflation reports as key events that will influence the market's next move. The divergence between equities and Bitcoin discussed in the video is a fascinating and ongoing narrative. Today, Bitcoin is trading around $112,000 to $114,000, struggling to find clear direction while major stock indices continue to test all-time highs. The jobs report revision was indeed substantial and has solidified expectations for a Fed rate cut next week, with the CME FedWatch tool now showing a near 100% chance of at least a 25 basis point cut. The Producer Price Index, PPI, data for August was just released and showed an unexpected 0.1% decline, reinforcing the case for the Fed to ease its policy. This should theoretically be a positive catalyst for assets like Bitcoin, yet the price action remains sluggish. This lends weight to the speaker's theory that some institutional players may be rotating out of crypto and into rallying stocks. Meanwhile, the dynamic between Ethereum and Solana is very real. ETH is currently priced around $4,400, and while BlackRock's ETF saw a significant inflow yesterday, this came after 6 straight days of outflows, indicating some uncertainty. Solana, trading near $224, continues to attract interest and outperform in the short term. With the important CPI report scheduled for tomorrow, the market is clearly in a holding pattern, waiting to see if inflation data will finally push Bitcoin to react more like the risk-on asset its holders expect it to be. In the latest video from Crypto Banter, the host introduces a trading tool called the 24/7 Terminal, designed to help users act on crypto news with incredible speed. The idea is that this terminal, much like a Bloomberg terminal in traditional finance, gathers breaking news from many sources and lets you place a trade on the relevant crypto with a single click. The presenter shows how they've personally used it to get into profitable positions over the past 2 weeks. A big point is that there are limited spots to keep the advantage effective, and a discount is offered for a short time. The video walks through the entire setup. You get a special license key when you sign up, download the software, and then connect it to your crypto exchange, like Blowfin or Binance, using an API key. A key security step is to make sure the API permissions are set only to trade and not withdraw, to protect your funds. You can preload your desired trade sizes like $200 or $1,000. So when news drops, you can instantly execute a trade without fumbling with numbers. The goal is to be faster than the rest of the market, trading alongside the insiders. The concept of a dedicated crypto news trading terminal is compelling, especially in a market that moves so quickly on headlines. The tool's value comes from reducing the time between getting information and acting on it. However, this style of trading is not without its risks. The crypto market is currently treading cautiously, with Bitcoin hovering around $111,500 and Ethereum near $4,300. Sentiment is in the neutral to fear zone, with many traders waiting for clearer signals from macroeconomic events like the Fed's upcoming meetings. In such a choppy and uncertain environment, a tool built for high-speed reactions could amplify losses just as easily as gains. Technical issues like API connection delays or software bugs are a real concern that can lead to failed or poorly timed trades. Furthermore, there's a security angle to consider. The recent hack of Swissborg through a partner's API vulnerability led the staking platform Kiln to withdraw 1.6 million ETH as a precaution, showing just how critical API security is. While the video correctly advises against enabling withdrawal permissions, any third-party connection to an exchange account introduces a layer of risk that users must be comfortable with. In the latest video from Crypto Casey, she explains that while Bitcoin recently dipped to around $18,000, it's still technically in a bullish trend unless it closes a week below $14,000. The big story is the movement of money from Bitcoin into major altcoins like Ethereum and Solana, signaling that we are on the verge of the biggest altcoin season in history. A key indicator for this is the Bitcoin dominance chart, which shows the percentage of the total crypto market cap that is in Bitcoin. This dominance level is now dropping below the 60% mark, a pattern very similar to what kicked off the huge 2021 altcoin run. The video's core idea that an altcoin season might be approaching has some backing from current market signals, but the price points mentioned are dated. As of today, Bitcoin is trading significantly higher at around $112,381, a stark contrast to the $18,000 level mentioned in the transcript. Ethereum and Solana are also much higher, trading at about $4,327 and $224 respectively. This massive price difference shows how quickly this market moves and tells us the video was likely recorded during a previous market cycle's bottom. In the latest video from DataDash, Paul Sampson explains that Bitcoin is showing strong upward movement following new inflation data. He recaps his analysis from earlier in the week, where he set price targets of $115,000 and $118,000. Sampson walks through the recent price action, noting a liquidity sweep that trapped both short and long traders before the real move began. A key bullish signal he points to is an inverse head and shoulders pattern, a technical formation that suggests a market bottom is in. The measured target from this pattern lines up with his $118,000 to $119,000 prediction. He also looks at the bigger picture, suggesting that after taking out the low from August, the market is now set to target the high of August's trading range. For this upward trend to continue, Bitcoin needs to hold above the $113,000 level. Sampson also quickly covers a few altcoins. He expects Solana to move quickly toward $274 and then $323 as long as it stays above $196. He notes that BNB has just set a new all-time high and has targets of $941 and then possibly $1,200. For Ethereum, he's watching for it to break above its recent range high to target levels like $4,600 and $4,700. The analysis in the video lays out a clear technical case for Bitcoin's push towards the $115,000 to $118,000 range. As of today, September 10th, 2025, Bitcoin is trading around $112,381, which shows the initial upward move discussed is in play, but facing some resistance. The market seems to be in a consolidation phase, holding its breath for the next major catalyst. The video's premise that the move was sparked by inflation data is timely, as new U.S. jobs data came in weaker than expected, and the producer price index edged down slightly. This economic cooling could encourage the Federal Reserve to consider rate cuts, a factor that typically benefits assets like Bitcoin. In the latest video from Crypto Wendy, she breaks down a major crypto supply chain attack that had everyone on high alert. A trusted developer's account was compromised through a phishing email, allowing malicious code to be injected into JavaScript packages used by many crypto applications. This code was designed to secretly swap crypto wallet addresses during transactions, redirecting funds to the attacker. The attack impacted both hot wallets and cold storage devices if users weren't carefully verifying addresses on their device's secure screen. Many major wallet providers like Ledger, Trezor, and MetaMask quickly responded, confirming their systems had security layers to protect users. The Ledger CTO later shared that the attack largely failed due to a flawed implementation that triggered early detection, resulting in almost no victims. Wendy wraps up by stressing the importance of good operational security, OPSEC, like using separate devices for crypto transactions and a burner phone for two-factor authentication, 2FA. The incident described in the video is a classic example of a supply chain attack, a threat that continues to be a significant vulnerability for the entire digital world, not just crypto. It closely mirrors the real Ledger Connect Kit exploit from December 2023, where a former employee was phished, leading to the compromise of a widely used software library. That event caused multiple DeFi applications like SushiSwap and Zapper to be at risk, leading to an estimated loss of over $600,000. While the attack in the video was fortunately unsuccessful, it shows how a single point of failure can have widespread consequences. The market's reaction to such events is often a dip in confidence, though it tends to be short-lived as seen with the current market sentiment, which is hovering in a neutral fear and greed zone around 43 out of 100. Bitcoin is currently trading around $112,000, and the total crypto market cap is holding steady at approximately $3.72 trillion, suggesting resilience. However, with recent major hacks, like the nearly $41 million theft from Swissborg, security remains a top concern. These events underscore the constant cat-and-mouse game between developers and attackers and reinforce the value of hardware wallets and extreme user vigilance. In the latest video from The Modern Investor, the main topic is whether traditional crypto market cycles are a thing of the past. The discussion points to a growing belief among institutions that the old pattern of a bull run followed by a major crash is over. This idea is backed by analysis from firms like Bernstein, which predicts the current crypto rally could last for several more years, possibly peaking in 2027. Another forecast even suggests the rise could continue until 2028. The video throws out some big numbers, including a prediction that Bitcoin could reach $418,000 by mid-2027 and a more immediate forecast of $200,000 within the next 6 to 12 months. To support this, the video mentions new institutional players entering the market. For instance, wealth management firm Cororio has invested about $6.5 million into various spot Bitcoin ETFs, and a Taiwan-listed company called Wise Link is backing a Bitcoin treasury firm with a $10 million raise. The host questions what this new environment means for everyday investors if prices just keep climbing without the expected major corrections. The video's central theme of a broken market cycle, or a super cycle, is a hot topic right now, and there's some real-world data to back it up. The massive inflow into spot Bitcoin ETFs throughout 2025 is undeniable proof of sustained institutional interest, something previous cycles lacked at this scale. We're seeing Bitcoin's price hovering around the $112,000 to $114,000 mark, which feels less like a bubble and more like a new floor being established. The political environment in the U.S. is also adding fuel to the fire. Recent legislative moves, like the Genius Act for stablecoins, are providing the regulatory clarity that big money has been waiting for. Analyst firm Bernstein has even extended its bull market timeline, now seeing a peak in 2027 and forecasting Bitcoin could hit $200,000 within the next year. However, it's not all a straight line up. This new market dynamic is also creating different pressures. For example, the huge surge in Ethereum staking, driven by institutional ETFs, is squeezing the available supply, which could lead to intense price volatility. While the idea of a multi-year bull run is compelling, the market is still sensitive to global economic factors. The old patterns of boom and bust might not be completely gone, but they are certainly being reshaped by the deep pockets and long-term strategies of these new institutional players. In the latest video from Alex Becker's channel, he explains that while his video title is clickbait, a time to sell everything is coming and investors need a plan. He believes 95% of crypto participants lose money because they fail to take profits. The market is not at a top right now. Instead, it's following a typical bull run pattern. First, Bitcoin runs, then liquidity flows into Ethereum, followed by the top 25 altcoins, and eventually into smaller cap coins and various narratives like AI, RWA, real-world assets, and meme coins. He predicts this cycle will likely repeat a couple of times before the real top is in. Becker suggests Ethereum could reach $5,500 to $6,000 in its next move. He identifies Cardano as a favorite to perform well, potentially hitting $3 to $5. The key indicators for a market top aren't specific prices, but rather social signals. These include extreme bullishness, where any bearish sentiment is aggressively attacked online, massive social media engagement, where even low-quality content gets huge views, and a rush of celebrities and mainstream retail into the space. He warns that the final top won't feel like a dramatic peak, but will look like just another dip that fools everyone. His advice is to start selling into strength when these social indicators are flashing red, rather than waiting for a specific price target that may never hit. Alex Becker's framework for identifying a market top using social sentiment instead of rigid price targets is a historically sound approach for retail participants. Currently, the market reflects a mixed but cautiously optimistic sentiment rather than the widespread euphoria he describes as a sell signal. The crypto fear and greed index is hovering in the neutral zone, sitting at 49. Bitcoin is trading sideways around $111,000 to $112,000, while Ethereum is holding near $4,300. This consolidation comes after a period of outflows from crypto funds, though Bitcoin spot ETFs have recently seen renewed inflows. The market appears to be in a holding pattern, awaiting clearer macroeconomic signals like the upcoming Fed meeting, with analysts expecting potential rate cuts in 2025, which could fuel another leg up. Becker's predicted capital rotation is visible in pockets. For instance, Avalanche, AVAX, has seen strong inflows and positive news from a partnership with Toyota, trading around $25 to $27. Similarly, Cardano, ADA, is showing bullish signs, trading near 88 cents as it attempts to break key resistance levels. The market is not yet showing the signs of a definitive top, such as extreme bullishness or retail mania. Instead, institutional adoption continues to build a base for the market, with significant inflows into spot ETFs and growing use of blockchain for back-office operations. The current environment seems more aligned with the middle phase of a bull cycle that Becker describes, where capital rotates between narratives like AI, which recently saw a 14% surge, and other altcoins rather than the. In the latest video from CryptoJeb, he lays out the case for a major Bitcoin rally that he believes is just around the corner. Bitcoin is currently struggling to break a significant resistance level around $113,000. Having recently fallen from that point to about $110,800. However, Jeb points to shrinking volatility, shown by tightening Bollinger Bands on the charts, as a classic sign that a big price move is coming within the next 1 to 2 weeks. He offers 3 main reasons why Bitcoin hasn't broken out yet. First, many investors are hesitant to act on the widely expected Federal Reserve rate cut until it's officially announced. Second, he discusses how the market is being manipulated. Large institutions are selling on public spot markets, which drives the price down, while their much larger purchases are happening privately over the counter, OTC, allowing them to buy more at lower prices. Finally, a massive rally in gold, which is up about 8% in 2 weeks to nearly $3,700 an ounce, is currently capturing the attention and capital of investors. Jeb predicts that once gold seems overvalued, that money will flow into Bitcoin, pushing its price to at least $150,000 and possibly over $200,000 by the end of the year. Jeb's analysis touches on several key factors currently influencing the market. As of today, Bitcoin is trading around $112,000 to $114,000, still struggling below the all-time high of roughly $124,500 reached in August 2025. The market sentiment is cautious, with the crypto fear and greed index in the neutral zone as traders await a clear catalyst. Jeb's point about gold is particularly timely. Gold has indeed seen a powerful rally, recently hitting a record high near $3,675 per ounce, and is one of the top-performing assets this year. This has certainly diverted some attention from crypto. The upcoming Federal Reserve meeting next week is the market's main focus. Expectations for a rate cut are extremely high, with the CME FedWatch tool showing a near 100% probability of at least a 0.25% cut, which is generally seen as a positive driver for assets like Bitcoin. The theory of institutional price suppression via OTC markets is also relevant, as reports in 2025 confirm that over 60% of crypto trading volume is now driven by institutions, with a significant portion happening through OTC desks to avoid market impact. With volatility low and a major economic decision pending, the market appears to be coiled for a significant move, just as Jeb suggests.